Imagine standing on thousands of rolling acres, watching cattle graze beneath a golden sunrise. The air feels quiet, the land seems endless, and every photograph screams freedom, wealth, and independence. It is the dream countless people carry when they imagine owning a ranch. Social media celebrates wide landscapes, cowboy lifestyles, and million-pound properties that appear almost magical. From the outside, ranching looks like the perfect combination of business and paradise. But economics rarely cares about appearances. Behind every picturesque fence sits a balance sheet, and behind every herd stands an owner making difficult financial decisions. A ranch can be worth millions while generating surprisingly modest yearly cash flow. That creates a strange contradiction. Someone may own extraordinary assets, yet still worry about paying wages, replacing equipment, or surviving another dry season. Think about a first-time buyer who spends years saving for the perfect ranch. After purchasing the land, they feel victorious. Then the bills begin. Fences need repairs. Water systems require maintenance. Livestock must be fed before they generate income. Machinery breaks. Fuel prices climb. Insurance arrives. Taxes never disappear. Suddenly, the dream starts looking less like a postcard and more like one of the most capital-intensive businesses in existence. The biggest surprise is not that ranches cost money. It is how slowly they earn it back. Unlike a shop that sells products every day, many ranches receive meaningful income only during specific seasons. Expenses, however, arrive every single week. Cash leaves constantly, while revenue often waits. That mismatch changes everything. A profitable year on paper can still feel stressful if bills arrive before customers pay. Many owners discover that wealth tied up in land cannot easily cover everyday operating costs. They may own valuable acreage yet struggle with liquidity, the simple ability to access cash when it matters most. This is why understanding a ranch requires looking beyond the cattle and into the numbers. Every acre, animal, machine, and decision either strengthens or weakens the business. The beautiful landscape tells one story, but the financial statements tell another. Before we can judge whether owning a ranch is a brilliant investment or an expensive dream, we first need to understand where every pound goes the moment the purchase is complete. That's where the real economic journey begins. Because once the purchase is finished, the romantic dream gives way to the unforgiving mathematics of ownership, risk, cash flow, and survival itself. Buying a ranch is the moment many people feel they have achieved the dream. But financially, it is only the starting line. The purchase price grabs all the attention because it is the biggest number on paper. Yet experienced ranch owners know that signing the contract is simply unlocking a long list of future expenses. The land may be yours, but making it productive is an entirely different challenge. Start with the obvious cost: the land itself. Prime grazing land, reliable water access, and good infrastructure can push prices dramatically higher. Then come the assets that allow the ranch to function. You need livestock, fencing, barns, corrals, storage facilities, tractors, trailers, feed equipment, and reliable vehicles. Even before a single animal produces income, hundreds of smaller purchases quietly add up into a staggering investment. Water deserves special attention because it is often more valuable than people realize. Wells, irrigation systems, pumps, pipelines, and water rights can determine whether a ranch thrives or struggles. A beautiful property without dependable water can quickly become an expensive liability instead of a profitable business. Now consider financing. Suppose someone buys a ranch with borrowed money, believing future cattle sales will comfortably cover the repayments. That assumption works only if interest rates remain manageable, livestock prices stay healthy, and unexpected costs remain limited. If borrowing becomes more expensive or market prices fall, the same loan that once looked sensible can suddenly squeeze every pound of available cash. This introduces an important economic principle: productive assets versus non-productive assets. Productive assets directly generate income, such as healthy breeding cattle or quality grazing land. Non-productive assets may still be necessary, but they do not immediately create revenue. A luxury farmhouse renovation might improve comfort, yet it rarely increases annual cash flow enough to justify its cost. Smart ranch owners constantly ask whether every investment improves productivity or simply increases expenses. Imagine comparing a modest 500-acre ranch with a sprawling 5,000-acre property. The larger ranch sounds far more impressive, but bigger does not automatically mean more profitable. More land often means more fencing, longer roads, additional equipment, higher maintenance, and greater labor requirements. Scale can create opportunities, yet it also magnifies mistakes. The purchase is only the opening chapter. Before a ranch can reward its owner, every asset must begin earning its place on the balance sheet, raising one critical question: where does the money actually come from once the gates finally open? A ranch cannot survive on beautiful scenery alone. Land may be the foundation of the business, but revenue is what keeps the gates open, the livestock healthy, and the bank satisfied. Many people assume a ranch simply raises cattle, sells them, and pockets the difference. In reality, successful ranches operate more like diversified businesses, with multiple income streams working together to smooth out the highs and lows of agriculture. For many operations, cattle sales remain the primary source of income. Ranchers breed cows, raise calves, and eventually sell them to feedlots or processors. The timing of those sales matters enormously because market prices can swing throughout the year. Selling at the wrong moment can erase months of hard work, while favorable prices can transform an average season into a profitable one. Some ranches expand beyond basic cattle production by investing in superior breeding programs. High-quality genetics can command premium prices, allowing owners to earn more from fewer animals. Others grow hay, producing feed for their own livestock and selling any surplus to neighboring farms. Leasing grazing rights creates another reliable income stream, especially when nearby producers need extra pasture during dry periods. Modern ranches often look beyond agriculture altogether. Hunting leases, guest accommodation, horseboarding, educational tours, weddings, and farm experiences attract visitors willing to pay for rural experiences. In some regions, renewable energy companies lease land for wind turbines or solar panels, while environmental programs reward landowners for conservation or carbon storage. These additional revenues may seem unrelated to cattle, yet they often provide stability when agricultural markets become unpredictable. Seasonality makes cash flow especially challenging. Expenses arrive every month, but significant revenue may appear only once or twice a year. That means careful planning is essential. Imagine a ranch expecting strong autumn cattle prices, only to see the market fall by 20% before the sale. The animals still required months of feed, veterinary care, and labor, but the final check is dramatically smaller. Profit can disappear without the rancher making a single mistake. This explains why experienced owners avoid relying on one source of income. Diversification is not simply a growth strategy, it is a survival strategy. A weak cattle market might be offset by hay sales, tourism, or lease payments, helping the business remain financially stable during difficult years. Most people think ranches succeed because they sell cows. The reality is that the strongest ranches build several streams of income that support one another. Yet, earning revenue is only half the equation, because every pound that comes in must survive an even greater challenge: the relentless cost of keeping the ranch running. Every decision now faces relentless operating expenses daily. Running a ranch means paying for problems long before they become visible. The cattle might look healthy, the fields may seem peaceful, and the machinery could appear reliable, but every day quietly creates new expenses. Unlike many businesses that can pause production during slow periods, a ranch keeps spending whether sales happen or not. Feed is often the largest ongoing cost. Every animal must eat, regardless of market prices. If drought reduces natural grazing, owners must purchase additional hay or grain, sometimes at sharply higher prices. Veterinary care protects herd health, while vaccinations, breeding programs, and emergency treatments add further costs. Labor is another major expense. Experienced ranch workers are skilled professionals who understand livestock, equipment, and land management. Keeping good employees often requires competitive wages, housing, training, and reliable working conditions. Fuel powers tractors, trucks, generators, and other essential machinery. When fuel prices rise, nearly every activity becomes more expensive. Then come the repairs people rarely think about. Fences break, gates sag, water pipes leak, irrigation systems fail. Barn roofs need maintenance. A single storm can destroy infrastructure that took years to build. Every repair demands both money and time, and delaying maintenance usually makes the final bill even larger. Depreciation is another hidden expense many beginners overlook. Tractors, trailers, loaders, and other equipment slowly lose value as they age and accumulate hours of use. Even if nothing breaks, these assets are becoming less valuable every year. Smart owners budget for eventual replacement, instead of waiting until a critical machine fails. Taxes and insurance continue regardless of profitability. Property taxes must be paid, and comprehensive insurance protects against accidents, natural disasters, liability, and equipment damage. Cutting insurance may save money today, but one unexpected event could threaten the entire business. Imagine a new ranch owner carefully calculating cattle revenue for the year. Everything looks promising until an irrigation pump fails during the hottest month. Replacing it costs thousands of pounds, while emergency water deliveries increase operating expenses even further. Suddenly, months of expected profit disappear because one essential system stopped working. The biggest lesson is that ranch economics are defined just as much by controlling costs as generating revenue. Every pound saved through efficient management strengthens the business, while every overlooked expense quietly eats away at future profits. Understanding these relentless costs also prepares us for the greatest uncertainty no budget can completely control: the unpredictable power of weather and everything it can change overnight for every ranch owner, regardless of experience or preparation alone against nature's immense force every single season ahead. The next challenge is unlike any spreadsheet. Markets fluctuate, but weather can rewrite every assumption overnight. Rain may never arrive, rivers can flood, disease may spread, and wildfire can erase years of careful planning. Even the best managers cannot negotiate with nature. They can only prepare, adapt, and hope their financial cushion is strong enough to survive until conditions improve again. That reality leads directly into the biggest risk every ranch owner must eventually confront: weather. Every business faces uncertainty, but few industries are as exposed to forces beyond human control as ranching. A retailer can launch a promotion when sales slow. A manufacturer can increase production to meet demand. A ranch owner, however, wakes up each morning knowing that the single biggest factor affecting their business is something they cannot negotiate with, predict perfectly, or control: the weather. A season of steady rainfall can transform pastures into rich grazing land, reducing feed costs and improving livestock health. The exact same ranch can become a financial burden after months without rain. As grass disappears, cattle still need to eat, forcing owners to purchase expensive hay and grain. Those extra costs arrive immediately, while the animals may not generate income for months. Now imagine a prolonged drought. Water sources begin shrinking, pasture quality declines, and livestock gain less weight because nutrition suffers. Some ranchers are forced to sell animals earlier than planned, simply because they cannot afford to feed them. Unfortunately, many other ranchers make the same decision at the same time, increasing supply and pushing market prices down. Costs rise while selling prices fall, creating the worst possible combination. Floods create a different set of problems. Fences are washed away, roads become unusable, barns are damaged, and valuable grazing land may remain underwater for weeks. Disease can spread more easily after extreme weather, increasing veterinary bills and reducing productivity. Wildfires bring another threat, destroying pasture, infrastructure, and sometimes entire herds within hours. Commodity prices add another layer of uncertainty. Even if weather conditions are favorable, ranchers cannot simply charge higher prices when their own costs increase. Beef prices are influenced by national and global supply, consumer demand, imports, exports, and broader economic conditions. A perfectly managed ranch can still face disappointing profits because market forces move in the wrong direction. This is why successful ranch owners build financial resilience instead of assuming every year will be profitable. Emergency savings, diversified income streams, insurance, and conservative borrowing all help businesses survive difficult seasons. Preparation cannot eliminate risk, but it can prevent one bad year from becoming a permanent disaster. After seeing how unpredictable ranching can be, an obvious question emerges. If weather, markets, and operating costs create so much uncertainty, why do wealthy families, institutional investors, and experienced entrepreneurs continue buying ranches? The answer has surprisingly little to do with cattle and almost everything to do with the land beneath their feet. After everything we've covered, ranch ownership almost sounds like a terrible investment. Operating costs never stop, weather can wipe out profits, and cattle prices rise and fall with the market. So why do wealthy families, investment funds, and long-term landowners continue buying ranches? The answer often has less to do with yearly income and far more to do with what happens beneath every hoof: the land itself. Unlike machinery, which depreciates over time, productive land has historically tended to increase in value over long periods, particularly in regions with growing populations, limited supply, and expanding infrastructure. A ranch may produce only modest annual profits, yet the underlying property quietly becomes more valuable year after year. That appreciation can eventually outweigh decades of operating income. Imagine two owners. The first focuses only on this year's cattle sales. The second pays close attention to the long-term value of the entire property. 20 years later, both may have earned similar operating profits, but the second owner could be sitting on land worth several times the original purchase price. The real wealth wasn't created in the livestock market alone. It accumulated slowly through ownership of a scarce asset. Scarcity is one of the biggest drivers of land appreciation. No one is creating vast new stretches of productive farmland. As cities expand, recreational demand increases, and agricultural land becomes more desirable. Quality ranches often attract higher prices. Inflation can strengthen this effect because physical assets frequently retain purchasing power better than cash sitting idle. This highlights an important distinction between cash flow and net worth. Cash flow measures the money moving through the business each year. Net worth reflects the total value of what the owner possesses after subtracting liabilities. A ranch can generate average annual income while dramatically increasing an owner's overall wealth through rising land values. That doesn't mean appreciation is guaranteed. Some regions experience stagnant prices, while others decline because of economic conditions, water shortages, or changing demand. Smart investors never assume land values can only move upward. They evaluate location, access to water infrastructure, productivity, and long-term regional trends before committing significant capital. The most successful ranch owners understand they are managing two investments simultaneously. One is an operating business that must remain financially healthy. The other is a long-term real estate asset capable of compounding value over decades. Balancing those two perspectives separates patient wealth builders from short-term speculators. Of course, not every ranch benefits equally from appreciation. Some owners unlock extraordinary value, while others struggle despite owning similar acreage. The difference usually comes down to one critical factor: how the business is managed every single day. The difference between thriving ranches and failing ones rarely begins with the size of the property. It begins with the decisions made every single day. Two ranches can own similar acreage, raise the same livestock, and operate in the same region, yet produce completely different financial outcomes. Imagine Ranch A. It carries heavy debt, depends entirely on cattle sales, postpones maintenance, and reacts to problems only after they become expensive. Every setback forces more borrowing, making each difficult season even harder than the last. Now imagine Ranch B. Its owner keeps debt manageable, tracks costs carefully, invests in better grazing practices, and develops multiple income streams. When cattle prices weaken, hay sales, tourism, or lease income help stabilize cash flow. Good years are used to strengthen reserves, not simply increase spending. The contrast is striking. Neither owner controls the weather or commodity prices, but one builds resilience while the other builds vulnerability. Successful ranching is less about working harder and more about allocating capital wisely, measuring risk, and making disciplined decisions long before a crisis arrives. Technology also plays a growing role. Data from grazing patterns, animal health, and feed efficiency helps owners improve productivity while reducing waste. Small improvements repeated consistently often outperform dramatic changes made in desperation. Ultimately, the most profitable ranch is not always the biggest or the busiest. It is the one that adapts, diversifies, protects cash flow, and thinks decades ahead. Those principles prepare us for the final lesson: what owning a ranch truly means. Owning a ranch is far more than raising cattle or buying beautiful land. It is the challenge of balancing cash flow, controlling costs, managing risk, and thinking decades into the future. The most successful owners understand that today's profits matter, but tomorrow's land value, resilience, and disciplined decisions matter just as much. In many ways, a ranch is both a demanding business and a patient investment. The greatest lesson extends beyond agriculture. Lasting wealth is rarely built by chasing appearances. It is built by understanding the economics hidden beneath them, then making smarter decisions because of that knowledge every day.